Hello, it's Adam Hewison coming to you from the digital studios of Market Club, and we're looking once again at the S&P 500, and it had a remarkable rally today, but it really isn't out of the woods yet according to our work. If you remember last time in our video we showed you the Fibonacci retracement, so we've left that in, so it starts right here and ends at this point right here. So 62%, 61.8% right here is right around the 839 level. Now we've exceeded that, which is not unusual for a market to do that, but we're certainly in an area that I suspect the S&P is going to have a problem. Now, having said that, let's look at our trade triangle technology, and it's very simple to put our trade triangles on. We'll click here. This gives us our monthly, and as you can see from our monthly, we've been actually negative on this market from 1,272. Now our weekly is showing at 780 the market's going up. So you've got a conflict here. And what that conflict means is basically you should be out of the market presently. So let's just put our weekly triangles in here. And as you can see, we've had some nice trades here. We had a trade go short because that's the major trend right here. Major trend is the monthly, and that's the major trend. So major trend is down, so we've got a nice short position there. We covered that position here, and as we covered it, basically we were out of the market. Now the market's rallied back to an area we think it's going to have a problem, and what we'd like to see happen here is we would like to see this market sort of reverse and make a new low. Now we may have some choppy areas going back and forth, and may go back up to test the high. The recent highs around the 844 level, 842 level, but I think we're going to run out of gas here. And this is a key area to watch right here. If we move below this area, then we're going to see a retest of the lows around here, and actually I think we'll go lower. So let's just take this off the charts, and I want to show you something else I think you might find interesting. I'm going to take off all of these things. I'm going to, and it's so easy. What's nice about our new Fibonacci tool, you can drag it pretty much wherever you want, so you can make it precisely, just touch those lines, and you can drag it from here to, so this little zero does not have to be right there. You can go pretty much anywhere that you want to see the numbers work. So it's very easy to use, but to take it off, we're just going to click here, and then you just click on the cross, the red cross, and it's gone. To close it off, you just click here again, and it takes the little yellow box, so the Fibonacci is no longer on the screen. But let's take our trade triangles off, so just click here, and here the box will disappear. There it does. And I want to go to a line chart. We've just gone to a weekly line chart. So here's the line chart right here, and this is the S&P 500 weekly chart right here, line chart. So what I want to show you is something that we haven't talked about before, and it's some people believe in it, some people don't believe in it, but I've seen it happen a number of times. The difficulty is, of course, getting the count right, and we talked about the Elliott wave theory. And what it is, basically waves go up in 5 waves. You have the first wave that goes with the trend. This is counter trend. This is counter trend. Number 3 is always the longest wave, and then the 5th wave is the one that takes it to new highs. Now the reverse is true on the downside. So you'd have a market move down, up, and down into new lows, and that's considered that would be the first wave, the second, the third, the fourth, and the 5th final wave. Now these are how markets interpret the trends and the zigs and zags, and there's numerous small accounts in between these, but I want to show you something on the S&P 500 that I've noticed that I wanted to share with you. I want to take everything off the screen. Okay, so this is basically the pivot point right here. This was, in my opinion, the first move down. This move back here was move number 2, and then this was 1, 2, 3, 4, 5. This is number 3, and this is we're going to wave 4, and then we should have a final push down to new low ground. So what we're looking for, as we've said this before, we have a target zone of 500 on the S&P. Now that's significantly lower than we are right now. What's going to bring that about? I don't know. It may not occur, but the reality is that's still a viable target zone. The market, the S&P 500 market, has to go over to nullify this zone 943.85, and it has to do it this month. If that happens, then this target will be finished. We'll just ignore that as a target to the downside. However, if it doesn't do that, I think we can see another push down and a retest of the lows and a potential move below the lows. And if that's the case, then this 500 target for the S&P is very much on board. So this is Adam Hewison for Market Club. I hope you're enjoying our new charts. They're very exciting. If you haven't done so already, check it out. I think you'll enjoy the some of the tools that we have, and I'll see you on the web. Take care.